There are an infinite number of ways to invest in the market. Each investment option is one of a kind. The one-size-fits-all rule does not apply in the world of investing. In terms of risk tolerance and expected return, each individual or business is unique. When an investor is faced with the decision of selecting an investment option from a slew of alternatives, the risk and reward pattern can be perplexing. Risk and reward pattern exist in every investment option, whether it is fixed income securities like T-bills or derivative instruments like option. However, the degree of risk and reward varies and investors decide the pattern considering various parameters. In this course, we recognize the relationship between risk and return, source of risk, classification of risk, calculation of return, and calculation of beta. We will also learn how the beta factor plays an important role in understanding how much an investor should expect in the market considering a level of risk embedded in it. This will be achieved through the analysis of the CAPM. So why delay? Let's get started right away. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoy this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.
Hi, an oldest saying goes, no pain, no gain. Yes, so this quote can be cited in the context of investment management. Every business come across with a series of opportunities, and every opportunity will have benefits. At the same time, there will be a lot of costs involved in every opportunity. So one of such cost is opportunity cost. What is opportunity cost? For example, to win something, you may have to lose something else. To gain something, you may have to lose something else. That's exactly how investment works in real time. So what are we talking about? So we are talking about risk and return. So welcome to the course on risk and return. My name is Pawan Kumar Chandrapa. So in this entire series of videos, we are going to discuss the concept of risk and uncertainty, gambling versus investing, motivation for investment, sources of risk, classification of risk, calculation of beta, return and expected return, capital asset pricing model, and weighted average cost of capital. Well, we have a lot to learn. Let's begin our journey with the first topic, the concept of risk. Before we dive into the deep discussions on how risk is relevant to the investment world, let us have a basic understanding of how risk is actually works in real time and what is risk is all about. Basically, the moment you hear the term risk, that means there is a danger. There is something which is not comfortable, right? There is something very uncomfortable. Something is not okay, right? Something is not welcoming, right? It may be a probability of something bad happening. That may be one instance. Or it may be a condition involving exposure to a danger. Or it may be exposing someone or something to the danger. This is not actually okay. There is something very uncomfortable waiting for you. That is risk. Chances of damage, chances of injury or hazard, or it may be threat, or it may be a loss. So this is something about risk. Now, what is risk in investment world? We are talking about risk in investment world. So what is the risk? The degree of potential financial loss inherent in an investment decision. I have invested some money in the market. So I don't know what is going to happen. There's a lot of uncertainty. There's a lot of risk involved in every investment opportunity. Now I don't know what is going to happen to my investments. The degree of potential financial loss inherent in an investment decision. Or it may be a probability of losing some or entire money you invested. For example, you have invested 10,000 in the market. So what is the guarantee that you're going to earn return on your money? You may lose your money entirely, or a portion of your money would be lost in the market. So that is the risk in investment world. Risk is also considered as a deviation of actual returns from the expected returns. I expected X amount at the end of 1 year, so I've got some other amount. For example, let us say I'm going to invest 1,000. Today is 2022, right? I'm going to invest this money for 1 year, 2023. So at the end of 1 year, I'm expecting, let's say, 10% return. But at the end of 1 year, let us consider I'm going to earn only 5% return, right? So this, the gap, right? I expected 10% return. At the end of 1 year, I'm getting only 5% return. That means there is a deviation of return from the expected return. Expected return is 10% and what I got is 5%. That 5% is the gap. So that is risk. So this deviation of actual returns from the expected returns, that is risk in investment. Now, when we were talking about risk in investment, we talked about a lot of uncertainty and a lot of risk. Now, many times we hear people talking about risk. They talk about uncertainty and they consider both are interchangeable words. No. There is significant amount of difference between these two terms, risk and uncertainty. Now, what is the definition of risk? Risk is a situation of winning or losing something valuable. That is risk. Now, what is uncertainty? No knowledge of future event. There is an event, but you don't know what is the future event. Quantification can be done in the context of risk. So risk can be measured, but uncertainty cannot be measured. There is no scale to measure uncertainty. We can assign probability for risk. What is the probability of losing money in the market? Let's say 50% chance of winning trades, 50% chances of losing trades. But the same is not possible in the context of uncertainty because we cannot assign probability of a particular event is happening in the market. So that is not possible in the context of uncertainty. Controllability. So risk can be controlled, risk can be managed, but uncertainty cannot be controlled or managed. It cannot be managed. Mitigation is possible. So risk mitigation is possible using various measures. It is impossible when it comes to uncertainty. In the context of risk, it is possible to mitigate the risk. So what is the outcome when it comes to risk? When it comes to risk, you can measure the outcome. So what is the potential outcome? I may lose amount, I may gain some amount. That is the outcome. I can predict or I can understand that. But when it comes to uncertainty, it is not possible to understand the potential outcomes. Many times we use these terms. Yeah, so investment is also kind of gambling. And if you invest in stock market, people say it is equal to gambling while you're investing. Is it fact? No. There is a significant amount of difference between investing and gambling. What is that differentiates between investing and gambling? If you look at the nature of investing activities are planned activities. Okay, so these activities are very well planned. The investor knows how much is going to invest, how much is going to expect, what is the return expectations, how long he wants to wait in the market to see that returns. This is all very well planned and the investor is ready about all these aspects, is willing to wait for a particular period to see that results. When it comes to gambling, Gambling is not a planned activity. Many times it's an unplanned activity. It's a random activity many times. When you want to participate in gambling, you may have some idea about how much you're going to gamble. But when you actually enter into the activity of gambling, you may change your decisions. You may just randomly choose an amount to invest, or you want to put into the gambling activity. You don't know how much you're going to put, and you don't know how much time you want to spend, how many months or years you want to wait to see the result. And you don't have planned activities. You don't have any planning about how much to expect. Your expectations may be random. You may expect 50% return, 60% return, or 100% return. You invest 1,000 rupees, you expect 2,000 rupees. And there is no logics behind your expectations. So that is the nature of gambling. When it comes to orientation, investing activities are oriented for longer duration. Say 1 year, 2 years, 5 years, 10 years, 20 years down the line, I want to expect this much amount. This is the amount I'm expecting from the market. That's a fair expectations because there is logic behind what you're expecting from the market. When it comes to gambling, it is not true. It is short term. You expect results overnight. You expect results next day, next week, next month. Very short term orientation when it comes to gambling. Level of risk involved. In investing, the level of risk involved is comparatively lower. It is not nil, it is comparatively lower compared to gambling. When it comes to gambling, the risk is higher. Why risk is higher in gambling? Because this is a very random activity. You don't know how much you expect, how much to invest, and how much is the expectation. What is the fact? What is the reasonable expectation to be kept? You don't know that those aspects. You are just gambling, and that gambling is actually giving you that risk, like high level of risk. Return expectations in investing is very reasonable because you go with the market. You know what is the expectation. For example, if you invest in money market instruments, you know how much to expect. If you are investing in fixed income securities, you know how much to expect. When you're investing in equity market, you know what is the percentage of returns that can be expected from equity markets. That too, again, if you want to invest in Indian equity market, you know what is the average return expectation. And if you want to invest in US market, you know what is the return expectations for US markets. So you have a very fair idea of what is the return that you can expect. But when it comes to gambling, the return expectations are not possible because this is a very random activity. The things are happening randomly. You cannot expect. You cannot keep up very reasonable expectations. They are very aggressive when it comes to returns expectations. Motivation. What is motivation for investing? Investors focus on two things. One, protecting money against risk. Second, return. Risk and return. Protecting against the risk, making returns. These two are important motives behind investment. When it comes to gambling, you want to make money, but you want entertainment. Entertainment and high returns are the expectations, are the motives behind gambling. When it comes to investment, safety of funds, returns. These two are main motives behind investment activity. What is the level of risk involved in investment? It's a calculated risk. Let us say we are investing on fixed income securities. The risk level is lower. When I'm investing money in equity market, the risk is comparatively higher. So that is the understanding of risk in investing. But when it comes to gambling, risk is aggressive. Risk is very high. Availability of information. So is the information available? Yes. In case of investment activity, investor will take informed decisions. He knows what is the stock, what is the financial instrument, how much return that we can expect from this particular financial instrument. But when it comes to gambling, it is very difficult to guess or predict. So how much is going to be the return, because there is no information. As you know, information is key in the investment world. So that is not possible in the case of gambling. So why do people invest in market, whether it is capital market instrument or money market instrument? Why do people invest? There are two important possibilities why people invest in market. One, risk, managing risk. Let us consider I have 1,000 rupees in my pocket. If I keep it in my pocket or in the safety locker of my home, by the end of 1 year, my 1,000 rupees is going to lose 6% of its value. So what is that 6%? This 6% is the inflation rate, right? The current inflation may be 5% or 6%. If it is 5%, my 1,000 rupees will lose 5% of its value. If it is 6% of inflation, it is going to lose 6% of its value. So what I can do to protect against this loss of this value? If I keep my money in the pocket or in the safety locker of my home, this money will lose 5% of its value. So instead, what I'll do, I'll take this 1,000 and invest in fixed income securities. For example, it may be in T-bill. This is a treasury bill. So if I invest in the treasury bill, I can expect a risk-free return. So I can expect a risk-free return, that's 5% or 6%. So the government will promise you that 5% of returns on your instrument, financial instrument. At the same time, this is low risk because this particular financial instrument is issued by your central banks, and these central banks are backed by the government of that particular country. In this case, in our case, it is going to be a Reserve Bank of India who is going to promise you that return, right? So when a Reserve Bank of India is going to promise that return, it is backed by government of India, right? The government of India has taxing power. Even if Reserve Bank of India is not able to pay you this 5% of returns, government of India will pay you that 5% of return because they have taxing power. They can collect taxes from the citizens of country and they can pay you that 5%. Low risk, right? Guaranteed. This is guaranteed. Now, we talked about risk part of it. The other part of the story is return. It is not just about protecting your money, the value of your money against inflation. In this first case, what happened? You know that there is 5% of inflation in the market and every year your money is going to lose 5% of its value. Now, you have achieved 50% of your investment objective. That is, you protected your money against inflation risk. Now, the other side, you want to invest this money to make returns. So it is not just about protecting your money, right? You have to make returns out of it. So you're expecting returns. To earn returns more than that risk-free rate, 5% risk-free rate, what you do, you invest money in equity market or any other markets where you can expect returns. Let's say you are investing in equity market, equity shares. Consider equity shares are giving you an average of 10% return. There is no promise, mind you, there is no promise on equity returns. But if you look at the average returns of equity, you may see 10 to 15%. So you know that there is 10 to 15% of return on my investment. So that is the reason you're going to invest in equity market. When it comes to equity market, there will be shares or stocks, and you must be knowing shares are of high risk and there is no guarantee of money or there is no guarantee of your dividend or profits in equity market. Wherein fixed income securities, you had guarantee from Reserve Bank of India or Government of India. But when it comes to equity market, there is no guarantee of return. There is no guarantee of your principal repayment. Okay, that's why it is called high risk. Now, let's talk about the sources of risk. What are the risks that are common in an investment? So what are all risks that are prevalent in the investment world? Whether it is fixed income security or it is equity instrument where you have risk, right? So it is any financial instrument that is traded in the market will have one or other a sort of risk. So what are those types of risks that are common in this market? Interest rate risk is one of the most important risk that every investment is facing in the market. So what is interest rate risk? Consider there is a bond market and there is an equity market. Consider the inflation rate, the interest rate is 5%. The equity market is giving 10% returns. So people generally tend to shift to equity market because equity markets are giving better returns. Though there is a risk element, the markets are giving better returns. They'll shift their funds to equity market because that's giving 10% return. Now consider the inflation rate has increased. The interest rates are also increased. Now consider the interest rates are somewhere between 8 to 9%. That means if you keep this money in fixed deposits or with the banks, they'll give you 8 to 9% of returns. So what will happen? Those who have invested in equity market, they'll shift their funds to bank deposits or these financial instruments that are money market instruments because these instruments are giving them a very good return of 8 to 9%. Even if they keep their money in capital market or in the shares, they'll earn 10%, that too with the level of risk. There's a high level of risk in equity, right? So they'll think it's good to shift money to the fixed deposits where they can comfortably earn 9% without having much risk. So that's how interest rates will move funds in the market from one area to another, like from one source to another. Now, there is another risk is market risk. What is market risk? When a particular company facing a risk that is not just about this particular company, the entire industry is experiencing that problem. For example, iron and steel industry. If there is any change in the government policies related to iron and steel industry, that will have a cascading effect on the stock. For example, a Tata Steel, right? Tata Steel is also a very important, a major player in the area of iron and steel. So if there is any change at macro level, at the market level, there will be change in the performance of individual stock as well. So that is called market risk. Inflation risk. Let us consider you have invested your money for 6% return, right? Suddenly the inflation rate goes up to 7%. So what will happen? You will lose 7% of your value of your money, but still you're earning 6% of returns in the market. So that still leaves you with 1% deficit. That means your money is losing more of value than you are actually earning in the market. That is inflation risk. Exchange risk. The businesses that are involved in import and export business will certainly face this exchange rate risk. For example, let us say an Indian garment manufacturer exporting garment products to US, right? So US is importing garment products from India. Now consider Indian rupee has appreciated against dollar. What will happen? Though this is having a positive impact on the revenues of exporter, the importer may deny your goods because Indian currency has appreciated, right? So because we may have to pay more, we don't want to deal with you, or I don't want to buy so much of goods from you. I want to reduce the volume of products I'm purchasing from you because your currency has appreciated. So that will have negative impact on the business of exporter. So that is exchange risk. What is business risk? Business risk is nothing but this is something very specific to a particular company or a particular business where there may be employee turnover, there may be conflict between labor union and the management, or there may be problem with the supplies, there may be problem with the product, there may be problem with the manufacturing process or the service failures. It may be anything that is specific to that particular business. Remember, the risk that is called business risk can be managed, that can be measured, that can be controlled by a particular business, because this is very much in the control of company's management. Now, what is financial risk? So financial risk is basically the risk involved for a company when they borrow from debt instruments. When the company borrow from debt instruments, the company is supposed to pay interests, no matter whether the business is making profits or losses. So this will put a lot of pressure on the business when they're not really doing good, when they're in losses, when they're not doing good, when they don't have business opportunities. So this puts a lot of pressure on the company's financials. So that is one risk where companies need to be very careful. For example, when a company go for equity, what happens? When the business is doing good, when the business is under profit, they're supposed to pay profits or capital gains. When the business is not doing good, they need not pay profits, because this is understood. When business do good, then only they pay the profits. There is no obligation for a company to pay dividends even when the business is making losses. But when it comes to debt sources, when the company is highly leveraged, even when the business is not doing good, they are supposed to pay interest payments. So that is a financial risk involved in any investment. Now, what are the classification of risks? How risk is classified? Basically, the risk can be broadly classified into two categories: systematic risk and unsystematic risk. So what is unsystematic risk? Unsystematic risk is also called as non-systematic risk or specific risk, or this is also called as diversifiable risk. This is also called as residual risk. This is unique to a specific industry or a company. So why it is called unique? It can be mitigated, it can be controlled, it can be managed. So that's why it is called unsystematic risk. For example, competition, decline in sales, change in management, negative consumer feedback, all this can be managed. This is very much in the hands of management of the company. So they can devise strategies to manage all those things, and that's why it is in the control of company. So that's why it is called unsystematic risk. There is another category of risk that is called systematic risk. So this is also called as undiversifiable risk, volatility, or it is also called as market risk. Why it is called systematic risk? It is affecting the entire market. It is affecting the overall market. That's why it is systematic risk. Good thing is this systematic risk can be measured, mitigated, and managed. Okay, so this can be measured using beta factor. So beta factor is used to measure the systematic risk. So what is beta? So beta, this is also called as beta coefficient. This is a measure of volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. Beta is one of the important parameter in capital asset pricing model. When we are understanding what is the return expectations in the market, let us say I am deploying some funds in the market. So what is that I should expect from the market, and what are the parameters on which I should expect that particular return? So it is extensively used. This is one of the critical factor in capital asset pricing model. So now we know that beta is a measurement of systematic risk. So the beta factor is used to measure systematic risk in the market. Now, how do we measure beta? So what is the benchmark against which we can compare beta factors? When market is highly volatile, what beta indicates? When market is less volatile, what beta indicates? When beta is less than 1, that means the stock is less volatile than the market. For example, Infosys shares. Infosys shares are listed on BSE Sensex. BSE Sensex is the index, benchmark index. When BSE Sensex is moving upward, if Infosys stock is also moving upward, but not in the pace in which the market is moving, the pace in which BSE Sensex is moving upward, then it is called beta is less than 1. It is moving, of course, but not in the pace in which it is the market is moving upward. Beta greater than 1. That means the stock is highly volatile than the market. When BSE Sensex is moving, Infosys share price is also moving, but it is moving more than the pace in which BSE Sensex is moving. For example, if there is 5% change in the level of BSE Sensex, Infosys share will move more than 5%. So that is called beta more than 1. When beta is equal to 0, so what is the indication of beta is equal to 0? That means the stock is not responsive. It is not responding to the changes in the level of market. Whether the market is moving upward or downward, the stock is not responding to the changes in the level of market. So that is beta is equal to 0. Now, we know that beta is a measurement of systematic risk. So the beta factor is used to measure the systematic risk in the market. Now, how these values are calculated? We have seen beta is more than 1, less than 1, beta is equal to 1, beta is equal to 0, right? So how these values are created, how these values are calculated. There are two important methods to calculate beta: using equation, using formula, and the second method is using regression analysis, that is MS Excel. We can use MS Excel to calculate the values for beta. So I'll show you both the methods, how to calculate beta using equation as well as regression analysis. So whichever the method is convenient for you, you can go for it based on your requirement. So first, let's move with the first method, that is formula method. Measurement of systematic risk is using this formula. So beta is equal to covariance of market and stock. So X, M, that means market and stock, divided by market variance. So beta factor, covariance between ith asset and the market. That means we need to calculate covariance for market as well as the stock, right? And market variance. So let's have a look at an example so that it is clear to you. Here is an example. Table below shows the data for shares of Sky Limited and the market returns. Find the beta for Sky Limited. So there are three market conditions: optimistic, fair, and poor. Market return 16%, 12%, 3%. That means 16% in optimistic conditions, 12% in fair market conditions, and 3% in poor market conditions. So what are the returns for stock? 20% in optimistic condition, 30% in fair market conditions, and minus 5% in poor conditions. And the probability is 0.4%, 0.4, 0.4, 0.2. So this is the problem. So there are 4 stages in which we need to approach this calculation, the beta calculation. Step 1, we need to calculate the expected return for market and stock. Step 2, we have to calculate variance, and once we calculate variance, we have to calculate the standard deviation for market and stock. After that, step 3, calculation of covariance for market and stock. And finally, we use beta formula and we identify the beta factor. So let's see how to do this. Step 1, as I mentioned, we need to calculate expected returns for market and stock. So what is the formula to calculate expected return? So expected return is equal to summation n, I is equal to 1, P into R. So this is the formula. This is an example. So what we need to do, we need to calculate expected return for market, and then we need to calculate market return for stock. First, we will see market returns, expected returns for market. So what is the formula? Probability into return. So probability and returns. Okay, so probability and return. So first we will see this pair, market return and probability. You see 18 into 4. So 18 is market return, probability is 0.4. 14 into 0.4. 14, 0.4. 5 into 0.2. So we have multiplied. So the result is 13.8. So what is 13.8? It is expected market return. Okay. Now we have to calculate expected return for stock. So what is stock return? 21%, 14%, minus 2%. So we have to multiply stock returns with probability. So 21 into 0.4, 14 into 0.4, and minus 2 into 0.2. So expected return for stock is 13.6. So now we know the expected returns for market and stock. Step 2, we have to calculate variance. And using variance, we have to calculate standard deviation for market and stock, Sky Limited stock. So what is the formula for the calculation of variance? So summation n I is equal to 1, probability into return minus expected return whole square. So in this formula, P is probability factor. So probability factor, R is return, and then E into R is expected return. So this is the formula. So we have to plug in values into this formula. Now, let us first do this for market returns. Okay, so first we will see market returns and then we will see stock returns. So standard deviation for market return. Remember, we are calculating variance. Using variance, we calculate standard deviation. Okay, so what is the formula? So probability is, this is for market. So 0.4, probability is 0.4. 18 minus 13.8. What is this 18? This 18 is market return minus 13.8 is expected return for market, 13.8. Okay, this is one part. Plus, in the second condition, 0.4, that is a fair market condition, 0.4 into 14 minus 13.8. So what is 14? 14 is fair market return minus 13.8 is expected market return, plus third situation 0.2. So 0.2 is poor market situation, market condition. 0.2 into minus 8.8. Okay, so this 5 minus 13.8. 5 is the market return minus 13.8 is the expected market return. So 13.8. So these are the probability factors, these are the market returns, and this is the expected market return. So the result is market variance is 22.56, and if you take the square root of 22.56, that is the standard deviation. Standard deviation is nothing but the square root of market variance, right? So 4.75. This is the standard deviation for market. Remember, we have calculated standard deviation for market. So we are yet to calculate standard deviation for stock. So now let us calculate standard deviation for the stock. So the same apply the same formula, just plug in the value. So what are you going to take? Take these values, 21, 14, 2. So 21, 14, 2. Okay, and what is the probability factor? 0.4, 0.4, 0.2. So 0.4, 0.4, 0.2. And what is that value you are going to take? Stock returns. Stock return is 13.6. Okay, expected return for stock is 13.6. So that is 13.6 we have taken. So if you take the results of this calculation, so variance for stock is going to be 70.66. And if you take standard deviation is simply a square root of variance, so 8.4. The standard deviation of stock is 8.4. So now we are done with two important steps in the process of calculating beta. Now, what is the third step for the calculation of beta? You need to know the covariance for market as well as the stock. So you need to calculate covariance for market and stock. So how do we calculate covariance for market and stock? So covariance is equal to probability into market returns minus expected market returns and returns for stock minus expected return for stock. So that is the formula. So you just need to plug in the values. So probability is 0.4, market return is 18. So where we have taken this, 18 is the market return minus 13.8. So what is the 13.8? 13.8 is expected return for market, 13.8. Okay, 18 minus 13.8. Now 21 next. So sky limited. So we have to take, this is stock. So this first part is for market and the second part is for stock. So 21 minus 13.6 because this is stock return 13.6, right? Plus 0.4. This is one probability and this is second probability and this is third probability. 0.4, this is one value, and 0.4, this is another probability, and 0.2, this is another probability. So if you take this, the covariance of market and stock is going to be 39.91. So that is covariance of market and stock. So this is the third stage, step 3. Now we have the step 4, that is calculation of beta. Now we have to plug in all these values into the formula. So what is beta formula? The covariance of XM, covariance of market and stock, divided by market variance. So covariance of market X and M is 39.91. Market variance is 22.56. This we have calculated earlier, right? So if you take the result of this, the beta is going to be 1.77. Remember, beta is 1.77. That means beta is highly volatile, right? So the 1.77 is highly volatility. Like in this case, the stock is highly volatile. It is more volatile than the market. So the beta, the stock is more volatile than the market. So what is the suggestion for an investor? If an investor is looking for the less risk, better avoid the stock because this stock is highly volatile. If there is any small change in the performance of index, this stock will react more aggressively towards that situation. So it's very risky in the equity market. So that is how we calculate and interpret beta factor. Now let's understand how to calculate beta using regression analysis, or using Excel. How can we calculate beta factor? Before we calculate beta using Excel, we need to do a little bit of groundwork because we need some data. We need time series data to calculate beta on Excel. So to do that, we have to download time series data from any of the official websites of stocks. Maybe you can download time series data from NSE or BSE, or you can download from even from Yahoo Finance. So for convenience, I'm going to use Yahoo Finance to download the time series data because it's very simple. So first you have to download the data and you have to make a little bit of formatting to clean up the unwanted data. Then the data is ready for the calculation. So let's start. Let's see how to do download of data and how to formatting, and then we'll get into the calculation part. As I mentioned, you can use any of these methods, formula method or Excel method, based on your convenience. For simplification, it's better to go for Excel because it's very straightforward. So let's see how to download data and how can we format the data to make it ready for the calculation. So you can go to Yahoo Finance and download the data. Let's say we are going to understand the beta for Infosys stock for the last 5 years. Infi is the code. So this is the Infosys stock page. So go to historical data. choose the frequency 5 years, because I want to see the beta for the last 5 years. Choose the data point is historical prices, and then choose the frequency. For convenience I'm going to use weekly. So apply, download. So you need not keep this data, hence I'm deleting. Even volume data is not required, so I'm just going to delete that. So this is adjusted close for INFI. Now the same thing, we need the same data for the index in which it is listed. Since Infosys is listed on Nasdaq, I'm taking Nasdaq stock prices. This is Nasdaq stock page, historical data. This is the market data. So Infosys is the stock, Nasdaq is the index. Since index is also traded, we say this is the price of Nasdaq. So choose the same frequency, same time series. Since you have chosen 5 years for stock, choose the same duration, choose historical prices, and choose the same frequency, that is weekly. Apply, then download. Here you need only adjusted close, so I'm taking only adjusted close. So these are the prices. So what we will do, we will filter this and arrange it, arrange the data in the format of latest to oldest. Okay, so this is latest to oldest. So remove this data, we don't have this data point. So take 14 February. Okay, so now what I'll do, I'll calculate, remove the filter first, calculate a return. So remember, this is Nasdaq. Okay, now calculate a return for stock and a return for market. So stock return in fee and market return Nasdaq. Okay, so how to calculate stock returns? So there is a formula for the calculation of return. So what is the formula? Today's price minus yesterday's price divided by yesterday's price. Same applies to market. Today's price minus yesterday's price divided by yesterday's price. So drag it till the end. Same thing. Remove these last two values because there is no previous data for this. So once you calculate stock returns and market returns, now it's time to calculate beta. To calculate beta, there is a formula called covariance P. Okay, so covariance P. So what is that you need to calculate this? You need to select returns, stock returns and market returns. So choose this stock returns, comma, market returns. Divided by variance of market returns. So this is the beta. So just remove the decimals. I'm just taking 2 digits after 0. 0.88. So this is one formula. There is one more formula to calculate this. There's a function called slope. Slope of x and slope of y. If you want to plot this data on a graph, so what is x and what is y? So you need to take both. So market return and stock return. So that is the same value. So you see, this is the same value. So here the beta is 0.88. What it indicates? So beta is less than 1. Okay. So when the market is moving upward, the stock will also move upward, but not in the pace in which the market is moving. In this context, when Nasdaq is moving upward, Infosys stock will also move upward, but not in the pace in which Nasdaq move upward. So it is less volatile than the market, but it is volatile. It is less volatile than the market. So that's how we calculate beta using Excel, or we use regression analysis method to calculate beta using Excel. Well, now we have seen one part of the story, that is risk. So managing risk in the investment world. So how risk is measured using beta factor, especially the systematic risk is measured using beta factor. And we have seen how we protect our funds against inflation by investing in fixed income securities, which gives risk-free return. Now, the second important reason why investments are done is a return. Basically, a return is the reward for taking a risk. So why do an individual invest in a risky investment option? Because there is a return. Anticipating returns, anyone would invest money in the market. In fact, a return is the motivation for any sort of investments. In fact, when we invest money, we generally expect positive returns. Of course, nobody wants to lose money. Nobody wants to expect losses in the market. By investing money, though, nobody wants to lose until and unless person is obsessed with the money, right? So returns are always expected in positive terms, and these returns are always quoted in percentage. So what is the percentage of returns I'm going to earn? It is 5%, 12%, 10%, right? Always quoted in terms of percentage. So when we say return, it may be two things. One, it may be dividend income, or it may be capital gain. So dividend is something companies issue at the end of year, or it may be of periodical durations, like for example half yearly, yearly, like that. It is not every month the company is going to pay the dividend, right? So it is periodic. What is capital gain? Some companies don't pay dividend. Instead, what they do, they use that profits, whatever the profits, they use it and invest or reinvest in profitable business opportunities and make the value of share grows over a period of time. That is called capital gain. So as we have seen the calculation of beta, and we have calculated returns for the calculation of beta, right? So how do we calculate returns? We calculate ending price minus beginning price plus income divided by beginning price. So what we did in previous section, today's price minus yesterday's price divided by yesterday's price. It is the same. So ending price is today's price. Beginning price is yesterday's price divided by beginning price. So what is the income? Income is nothing but it is a dividend. If there is dividend, we use that. If there is no dividend, we don't use that. It will be zero. So this is the formula. Ending price minus beginning price plus income divided by beginning price. So let's see an example so that it is clear in terms of calculation. Mr. Bama purchased the shares of XYZ Limited at rupees 50 and sold it for 55 after 1 year. calculate her returns under below mentioned conditions. There are various conditions. Two conditions here. One, assume the company is not paying dividend in the year. Condition 2, assume company is paying dividend of rupees 2. So for these two situations, we have to calculate returns. Let us see the first situation. Assume there is no dividend. So what is the formula? Return is equal to ending price minus beginning price plus income divided by beginning price. So here, what is the ending price? 55 at the end of 1 year. 55 minus beginning price is 50 plus 0. Why 0? Because we are assuming there is no dividend, right? Divided by 50, that is beginning price 50. So 10% is the return. Now let us see the second scenario. In second situation, what is that? There is a dividend of rupees 2. So 55 is the ending price, 50 is the beginning price, plus 2 is the dividend assumed divided by beginning price, so 50. So the result is 14%. And this is how we calculate return under various circumstances, assuming there is a dividend, there is no dividend. There is another concept called expected return. So what is expected return? What is the return that you expect? When you deploy your financial resources on risky financial instruments, definitely there will be expectations. There will be returns expectations. That is called expected return. Let's say I'm investing 1 lakh in equity shares. So what is that I'm expecting? I expect a return, let's say a 10 to 15% return. So why I'm not expecting 5% return when I'm investing in equity share? Because I'm risking my money putting in equity share. So had I thought of earning only 5%, I would have invested my money in fixed income securities like T-bills, because that is safer. 5% return is assured, the instrument is safer. But I'm taking extra risk. That's why I'm expecting returns more than that risk-free rate. Now, how to decide about how much returns to be expected? One of the most complicated questions to be answered in investment management. Everyone wants to find out answer for this. Okay, how much returns I should expect in a particular financial instrument? That is called expected return. Let us understand this with a couple of scenarios so that it is easy. Consider you have safely invested your money in a bank for, say, 6% returns. And this 6% is risk-free because this is, let's say this is FD, right? And this is secure. Now, let us say the person is Mr. Ram. He's earning 6% return with risk-free nature in a bank deposit. Now, you may have to convince him to shift his funds to medium risk investment option, which also gives him 6% return. Is it possible? Technically, nobody will go for this option because he is already earning 6% return with risk-free nature, is peaceful, is earning 6%. Why do Mr. Ram should risk his investment to earn the same 6% return with medium risk when he is already earning 6% in risk-free instrument? Why do Mr. Ram will shift his funds to 6% return with medium risk? So that is impractical, right? There is no way it is possible. Let's see another situation. Okay, in the second situation, let us consider Mr. Ram has invested his money in stock market and is earning 8% return, medium risk. Now, can you convince Mr. Ram to shift his investments to high risk investment option, which gives him 8% return? Right? is already earning 8% with medium term risk. Can you convince him to shift his funds to 8% return with risky investment option? It is medium risk, right? This is medium risk, this is high risk. Practically, Mr. Ram or whoever will not agree to go for it because with medium level of risk is already earning 8% and no point in going for 8% return to risky investment option. Okay, so that's a practical expectation, practical decision that every rational investor will take in the market. Now, how much percentage Mr. Ram can expect by investing in risky investment option? He is already earning 8%. To shift his funds to another investment option, how much percentage he would expect or he should expect to shift his funds? So that is the question to be answered in investment management. Now, to answer these questions, thankfully, there are so many models that helps us to answer this question. How much percentage of return that Mr. Ram or an investor should expect to shift their funds to risky investment options. So there is a model called capital asset pricing model, and this model is given by William Sharpe, and this was given during 1970s when he published a paper on portfolio theory and capital market. Basically, capital asset pricing model, this theory establishes the relationship between the expected return and the risk of investing in a security. So what is the return to be expected and what is the risk embedded in particular financial instrument? The expected return on a security is equal to the risk-free return plus risk premium, which is based on beta of that particular security. So capital asset pricing model helps us understand how much of returns that we should expect for a given level of risk in a financial security. So let's have a look at one of the examples. Before we understand example, here is a formula to calculate expected return under capital asset pricing model. So what is ER? ER is cost of equity or expected return. This is what you're going to expect. So what is this you're expecting? So to calculate this value, what you need risk-free rate. Okay, so this is RF, risk-free rate, and beta factor. What is beta? This is measurement of systematic risk. And RM minus RF. So what is RM? RM is market return and RF is risk-free rate. So RM minus RF, this is one component, that is market return. So this is the formula we are going to use for the calculation of expected return or cost of equity according to capital asset pricing model. Yeah, this is risk premium. Okay, so this RM minus RF is a risk premium and RM is market return. Let's take an example. If risk-free rate is 6% and market premium is 12%, beta factor is 1.5. What is the expected return of the security under capital asset pricing model? So how to calculate? Just plug in the values to this formula. So expected return is equal to RF. What is RF? RF is risk-free rate, that is 6%, plus beta factor. What is beta? 1.5. And this is market return, right? So RM minus RF. What is RM? Market return is so 12, right? 12%. 12% minus RF 0.06. So this is the value. So what is, just do the arithmetic calculation, we're going to get it. The return, the expected return is 15%. So 15%. 15% is the expected return for the level of risk embedded in a financial instrument. So how much you need to expect? We need to expect 15% return at this level of risk in the financial instrument. That is capital asset pricing model. Now, weighted average cost of capital, WACC, weighted average cost of capital. When we see the capital structure of every company, there will be a mix of so many sources. Okay, so companies generally do not borrow from one particular source. They may borrow from debt instruments, they may borrow from equity sources, they may go for preference capital, they may go for retained earnings. So many sources. That is the basket they could prepare with all the sources. And there are a lot of benefits going for basket of securities, basket of sources, instead of going for just one. Okay, since that is not the focus area in this series of videos, we're not going to spend time on that. So what is weighted average cost of capital? So this is overall cost of capital. When we say the company has borrowed from various sources, let us say the company has borrowed from debt and equity. What is the source? What is the overall cost of capital? When you put debt and equity into a single bucket, what is the overall cost of this particular capital? So weighted average cost of capital is the average rate of return a company expects to compensate all its different investors. The weights are the fractions of each financing source in the company's target capital structure. Let us say the company has borrowed 50% of its capital from debt, 50% of its capital from equity sources. So how you're going to calculate weighted average cost of capital? You're going to take the weights of each of these sources. Okay, you take the weights of these sources and you're going to calculate weighted average cost of capital. Okay, we'll see an example so that it is easy. Yeah. So before we go to the example, this is the formula to calculate weighted average cost of capital. So what is WD, RD? This is a weight. Okay, this is a weight of debt I'm putting, right? So what is the weight of the debt and what is the cost of debt? RD is cost of debt. So remember, interest is always tax deductible. That's why 1 minus T. So what is weight of equity? Weight of debt, cost of debt, weight of equity, cost of equity, return on equity. Okay, cost of equity. Then weight of preference share, the cost of preference share. So return on preference stock. This is the formula. So here is an example. A company wants to raise money. The company will sell rupees 15 million of common shares and expected return is 12%. The company will issue 10 million debt. The cost of debt is 8% and the tax rate is 35%. Find out weighted average cost of capital. Okay, so we calculate weighted average cost of capital in 4 simple steps. So step 1, first we need to understand what is the total value of the company. So what are the sources that company has chosen to borrow funds? For example, in this case, debt and equity are the only sources company has chosen. So debt and equity together, it is 25 million. Now, once we know the total value of the company, we have to calculate the weights of debt and equity in the entire capital structure. So if you see, debt weight is 10 million divided by 25 million. That is 10 million is the value of debt. So the weight is 0.4. Equity weightage is 15 by 25. So 15 million is the weightage. 15 million is the equity and 25 million is the overall value of the company. So 0.6. So now we know what is the total value of the company and we know the weights of cost, the weight of debt and equity. And now the third step, you capture all the necessary data. So weight of debt is 0.4. The cost of debt is 0.8. So that this is the interest rate. Then tax is 0.65. What is 0.65? 1 minus 3.5. 3.5 is the tax rate. Remember, always interest is tax deductible. So what is weight of equity? 0.4. And what is the cost of equity? 0.12. That is 12%, right? So 0.2. Now 0.12, right? Now step 4, substitute all the values in the equation. So just plug in all the values and you have this result. So 0.256, that is weighted average cost of capital is 25.6%. So this is the overall cost of capital of the company. So that is the calculation of weighted average cost of capital. So Here is a quick recap of what we have discussed so far. In investment world, risk means deviation of actual returns from the expected return. So we expected some return, but at the end of the year, what we got is a different return. That is a deviation of actual return from the expected returns. The motive behind investment is protecting the funds and earning profits, whereas in gambling, the motive is to have fun while earning higher returns. So always investments are oriented towards protecting against the risk and making returns. There is no fun element in investment activity. It is always a risk and return, managing risk and earning returns. So, what are the sources of risk? Financial risk, exchange risk, interest risk, market risk, inflation risk, business risk. So, these are the sources of risk for an investment. So, the measurement of systematic risk can be done using the beta factor. Return is the reward for taking risk and motivation for investment. Expected return refers to how much percentage an investor can expect by investing in a risky investment option. Capital asset pricing model is a theory that establishes the relationship between the expected return and risk of investing in a security. So, what is the return that I should expect in a particular financial instrument considering the risk embedded in it? And at the last, we have seen what is the weighted average cost of capital. This is also called as overall cost of capital. So weighted average cost of capital is the average rate of return a company expects to compensate all different investors. So what is the cost involved in each of the sources that has been borrowed from so that they can compensate to all the investors. I hope you enjoyed the video. Thanks for watching.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.